If I were to ask you what the capital gains tax rate is, a lot of you would say 15%. And you're not totally wrong, but you're partially wrong. And we're going to explore that today. We're going to look at the incredibly powerful 0% capital gains tax rate and how that interacts with ordinary income when you're looking at potentially doing Roth conversions while pulling money from a taxable account. We're going to look at what's the maximum amount of ordinary income plus capital gains that you could have to still pay zero tax. Let's jump in. All right, so here we are again using one of my favorite tax spreadsheets from 55E. Thanks again, Dan. And what I'm looking at right here are the capital gains tax rates. So here you can see if you're single, the capital gains tax rates from 0 to 44,625 is 0%. To 89,000, if you're married filing jointly, is 0%. So that's what we're going to be keying in on today. So coming over to our scenario here, basically what I'm showing is a married filing joint couple. They're not over 65, and I'm not going to mess with Medicare in this because they're not over 65. No Social Security to speak of yet, and let's maybe plug in $4,000 in interest. And here's where I'm going to add capital gains. And then we're going to assume they also have a tax-deferred retirement account. And so then we're going to mess with, hey, if this couple were to do Roth conversions on top of their capital gains that they're using for income, what would that look like? So as I scroll down here, you can see that when you have zero income, of course, your tax rate is zero. And so I'm going to show you as we add income how that is affected at different areas. So let's start with coming over here to this hypothetical taxable joint account. They're fake funds, they're fake investments, their cost basis, their current balance, and their unrealized gain. So let's just start with, hey, this couple, they're going to need $187,000 to live on this year. I made that number up because it happens to match this fund. So boom, they pull out $187,000 by selling that fund, and it triggers a $52,000 long-term gain. Let's assume these are all long-term gains. So I come over here and I plug in $52,000 of long-term capital gain. And how much tax are we paying? 0% still. Okay, pretty sweet. $52,000 in gain, zero tax. Okay, now what if they need a little bit more? Let's come back once again. Let's add another investment. Let's just go ahead and let's add both of these. So in this scenario, we've pulled over $500,000 from these funds, and the capital gain is $116,000. Let's see what that does. So $116,000 in long-term capital gains. Are we finally paying some tax? Yes, we're finally paying some tax because $116,000 total income from the $4,000 in interest plus the $116,000 in long-term gains, and then subtracting out the standard deduction leaves us $92,000 in income, and $92,000 minus $89,000, $252 times 15%. That's how we get the $457 in capital gains tax that we're going to pay on $20,000 in income. So pretty sweet. Now, what happens though if we layer more ordinary income into this? If I layer a Roth conversion of, let's say, $25,000. Okay, so we convert $25,000. We still have we basically now have $29,000 in ordinary income and $116,000 in capital gains. But ordinary income goes below capital gains and pushes the capital gains up. And so now you have $4,000 in tax, but still a crazy low effective tax rate. And by the way, you only have $1,300 in that scenario being taxed at ordinary income. So let's mess with this a little bit. And I'm just going to fudge this number. I'm going to change the interest amount to $2,700. And I'm going to zero that out. And we'll keep the ordinary income at $25,000. So if I plug in 89,250 and scroll back down here, boom, we're still at 0%, and ordinary income is still 0 because of the standard deduction. So if I then come in and just make this 92,000, up it a little bit just to cause a little bit of tax, there you go. So there you have it, 89,250 in capital gains plus 27,700 in ordinary income allows you to pay 0% in taxes. And by the way, I probably wouldn't even advise you to pay 0% in taxes, especially if down the road you're going to be paying 10, 12, or 22% taxes. But this gives you an idea of how powerful that 0% long-term capital gains rate can be. So there you have it. The 0% capital gains tax rate is really fun to use when you have the opportunity to do it. Now, a lot of moving parts to this. We didn't get into the benefits of converting higher amounts to avoid future RMDs. We didn't get into how higher income could affect premium tax credit subsidies for healthcare. Tax strategy in retirement is really complex. So if you want to continue to learn more for free, subscribe to my channel so that you can get my tax planning videos as they come out. But if you're ready to jump in and get all of retirement and tax strategy figured out as a DIY investor, go to my website, verifyfinancial.com, and schedule a time to meet with me to see if we're a fit. I bring on a max of 2 or 3 clients a month, and I only work with DIY investors. So if that sounds like you and you're ready to get this all taken care of, go check me out at verifyfinancial.com. Have a great rest of your day.